Welcome to this explainer. I am so incredibly excited you're joining us today because honestly, we're unpacking one of the absolute coolest intersections of human psychology and high-tech finance. We usually think of the stock market as this place of cold, hard numbers, right? Price to earnings ratios, moving averages, yield curves. But at its absolute core, the market is driven by people. It's driven by fear, by greed, by sheer panic and wild excitement. So today, we're looking at how advanced algorithms are actually attempting to measure that exact human emotion. We are exploring the science of AI sentiment analysis.
Okay, let's dive into this, because let's be real, it sounds a bit like science fiction, right? We're literally asking if a purely logical, math-driven machine can actually decode the feelings of a fundamentally chaotic market. Can an algorithm truly feel the mood? Well, okay, it doesn't feel the way you or I do, obviously, but it can absolutely read the room.
Think of sentiment analysis as essentially the stock market's giant mood ring. It's this automated process of using computers to scan and read millions of news articles, financial reports, and social media posts. And yes, that includes the absolute chaos of Reddit and Twitter. The whole goal is to figure out if the overall vibe about a specific stock, or even the market as a whole, is positive, negative, or neutral. It's a brilliantly simple idea at its core. If everyone is panicking and tweeting terrible things about a company, the stock price is probably going to drop. But if a new product gets rave reviews everywhere online, the price might just jump. This technology is trying to capture that collective human emotion at a massive, massive scale to predict exactly where the market is moving next. Section 1. Evolution of the tech, from rule followers to context readers. To really wrap our heads around how this works today, we kind of have to look at how the technology evolved. Back in the early days, we relied on the rule follower, which is basically classic natural language processing. Fast forward to today, and we have the modern context reader, powered by advanced large language models. And let me give you a perfect example of why this shift was absolutely critical. Imagine a sentence in a financial report that literally reads, "This stock is a disaster for short sellers, but great for long-term buyers." A simple rule-following algorithm, it sees the word disaster and just panics. It scores the sentence as purely negative. But the advanced AI, it actually gets the nuance. It understands that being a disaster for a short seller actually means the stock price is likely going up. It's a total game changer.
Let's break down those level 1 tools just a bit more. These classic NLP libraries, they're faster, they're cheaper, and way easier to set up. But they basically just function like a super strict dictionary lookup system. You've got tools like Vader, which is great for general social media, and TextBlob, which is super beginner-friendly. But then there's the Lofgren-McDonald dictionary. Now, this one is special because it was built specifically for financial text. It knows that, hey, in a normal everyday conversation, the word liability might not be a huge deal. But in a financial report, that's a very bad word, whereas profit is obviously good. It literally just matches words to a score.
But here is where we hit the true cutting edge, level 2. Instead of just blindly looking up words, models like ChatGPT, Llama, and Finbert actually understand the context. Take Finbert, for instance. It's a version of Google's BERT that was trained specifically and only on financial news. Twitter Roberta, that one is heavily fine-tuned to understand the slang and sheer unpredictability of Twitter. Now, what's really interesting about this slide is that third point right there, chain of thought. Studies actually show that when you prompt these open-source models, like Llama 3.1, to just think step by step, it dramatically improves their accuracy on complex financial texts. They don't just react anymore, they actually reason. Section 2. Real-world market applications, turning vibes into strategy. So, okay, we have this incredible technology that can literally read the mood of the internet. But how is it actually deployed on the battlefield by traders during crazy volatility or breaking news? Well, the most crucial strategic takeaway here is that the absolute scores, they don't matter nearly as much as the momentum. Let's say a stock drops from 90% positive sentiment down to 60% positive. That is a massive warning sign. Even though 60% is still technically in the positive range, that sudden, huge shift in direction is flashing bright red to an algorithm. You see, sentiment changes fast, often way before the actual stock price does, which makes it unbelievably valuable for short-term trading. I really want to anchor your attention on this number right here, 1.90. This represents the Sharpe ratio, which, if you know finance, measures risk-adjusted return of a specific model called SAPO. To put that into perspective, the baseline model, which relied entirely on standard price data, had a Sharpe ratio of 1.55. But when researchers took text sentiment analysis and combined it with that actual price data, the SAPO model boosted its performance to a highly impressive 1.90. It's huge. This brilliantly illustrates that the very best systems out there don't just read the news, and they don't just look at stock charts, they completely marry the two together. And because of that kind of performance, hedge funds and massive institutional investors are deploying these systems in a few key ways. First up, algorithmic trading. They're using these sentiment scores as immediate, real-time signals to buy or sell within milliseconds of a news story dropping. Second is risk management. Imagine the sentiment around a stock you own suddenly turns sharply negative. The system can automatically trigger a warning to immediately reduce your position. And third, portfolio construction. Investors are actively using extreme negative sentiment to hunt down overvalued stocks to bet against or short sell. And just how effective can that portfolio construction actually be? Take a look at this massive figure, 76.20%. That is the cumulative return achieved in one specific study that used the KRI-Finbert model to execute a short-selling strategy based purely on negative news sentiment. No joke. By accurately reading the room when bad news hit, the AI uncovered a highly profitable trading opportunity that others just completely missed. Section 3. The noise and the flaws. The villains of sentiment analysis. Now, before we go handing our entire retirement portfolios over to the machines, we really need to look at the reality and the flaws of this technology. Looking at the advantages side. Yes, it gives you an amazing early signal. Yes, it processes the impossible. I mean, no human alive can read 1 million Tesla tweets in an hour, but an AI absolutely can. And it completely removes human emotion from trading. But we have to look at the disadvantages. First up is the noise problem. Social media is just flooded with bots, hype, and sarcasm, and frankly, AI still really struggles to filter all that out. Second, the actual impact of sentiment on a stock's price is often pretty weak and short-lived, especially if the broader market is just confused. And finally, there's data leakage. This is a super common pitfall where developers accidentally cheat by training their models on future data instead of using rolling windows of past data. Section 4, Tools of the Trade, the Modern Sentiment Arsenal. Let's move to and see how this builds into the specific data frameworks moving the market today. If you're wondering what the modern sentiment arsenal actually looks like in practice, here it is. This simple 3-step flow. Fetch news, feed to LLM, extract score. This is the literal backbone of data processing frameworks like LangChain. What LangChain does is allow developers to build these complex, fully automated pipelines. They take abstract, messy news articles on one end and spit out clean, structured, mathematical sentiment scores on the exact other end, completely automatically. It's practically magic. And building directly on those pipelines, we get this advanced arsenal. We're talking professional tools like Reddit Signals by ICE. This tool specifically maps wild Reddit conversations straight to individual stocks, which helps institutional investors compress their information cycle. We also mentioned SAPO earlier. That uses reinforcement learning to directly improve a trading algorithm's decision-making, aiming for higher profits and lower risk. And for the open source community, there are incredible projects like Sentiment Alpha on GitHub. That one actually uses the Twitter Row-Better model to visually graph the real-time mood of specific stocks like Apple or Tesla. Which brings us to our final slide, and honestly, a crucial dilemma in the world of advanced finance right now. We call it the block box problem. You see, advanced LLMs are now so complex, packed with literally billions of parameters, that sometimes it is utterly impossible to know why they gave a stock a negative score. They just did. So it leaves us with this final, truly provocative thought. If an AI is generating massive returns and making you an absolute fortune, but you cannot fundamentally explain how it's making its decisions, do you actually trust it with your financial future? It is the ultimate question we have to answer as we continue teaching these machines to read human emotion. Thank you so much for joining me for this explainer.